Veronica Ng is a senior fixed income fund manager responsible for managing global and Asian-specific institutional mandates and retail funds at Lion Global Investors. She is the co-head of the Asian Credit Strategy team. What are the advantages of investing in an Asian-focused bond fund as compared to a global bond fund?
The advantage is that you enjoy higher yields. Bonds issued by Asian corporates typically offer higher yields compared to a US or European corporate of equivalent credit rating and equivalent tenor. For example, a 5-year US dollar bond issued by Shell, which is rated single A flat by S&P, trades at 1.8%. The Chinese oil majors PetroChina, Sinopec and CNOOC, which are rated one notch higher at A+, trade at 2.1 to 2.2% per annum. This provides investors with a nice pickup of 30 to 40 basis points for better credit rating. So the question is, why do Asian corporates trade at a discount to developed markets? This can be explained by a familiarity bias, plus the fact that the depth and liquidity of credit markets in developed countries is much deeper, as these markets have been around much longer. Asian credit markets is, in comparison, a younger market, and because it is younger, you get the first wave of better established companies within the region able to tap offshore dollar markets. Asian investors would derive comfort from being familiar with the issuers of the underlying securities in the Asian bond fund, and at the same time, you are rewarded with higher yield pickup.
Credit spread has been tightening and bond is in a 30-year bull market. Do you see a peak in the bond market? And how does your fund seek yield in this low-yielding environment?
The backdrop you described actually encapsulates the concerns for bond investors. Interest rates move lower each year, even when we think it has reached levels low enough to stimulate economic growth. And the gravity of negative rates in Europe and Japan are pulling credit spreads tighter, and this tightening does not commensurate weakening credit fundamentals in the current global economic slowdown. In this low-yield environment, the fund seeks to improve returns through several strategies. Firstly, we like subordinated debt instruments issued by banks and corporates for additional yield pickup against senior debt. Our evaluation is that the non-call risks or bail-in risks embedded in some of these instruments is low, given structural features of the bond and the friendliness of the banking resolution regime in Asia, and more importantly, the good financial standing of the issuers. Secondly, we like BBB rated credit names, which offer relative value compared to single A rated and AA rated names, which are trading at very stretched valuations. Thirdly, the commodity sector has lagged in the recent rally, and there is potential upside on the back of a recent increase in some commodity prices. Lastly, the Indonesian sovereign and quasi-sovereign names, which has been the outperformer year to date, still has some legs with continued stabilization in the oil and gas sector.
What are your views on negative yielding bonds, and does your fund invest in any of those bonds?
You can make money investing in negative yielding bonds too. 10-year JGBs and German bonds are trading at negative yields. If ECB and Bank of Japan step up their quantitative easing programs further and interest rates become more negative than your entry point, then you can reap capital gains. Theoretically, bond markets can move to new peaks even in negative interest rate environment. However, that will bring us deeper into uncharted territory. With negative interest rates, you end up with an upside-down world where borrowers get paid and savers are penalized. It is difficult to imagine what the market repercussions can be in the financial sector and the real economy if negative interest rates persist for a longer period of time. Fortunately, the fund does not invest in negative yielding bonds. The fund mandate focuses on bonds denominated in US dollars, and US interest rates are trading nicely in the positive zone.
In terms of country exposure, China seems to have a huge proportion of the allocation. Is it due to a top-down tactical call or purely the size and number of issues in Asia?
The portfolio allocation to China reflects the Jackie benchmark REITs. Chinese corporates dominated issuances in the debt capital markets for the past few years, whether by number of issues or by print size. Chinese issuers currently comprise about half of the US dollar Asian credit universe, and this is a reflection of the Chinese economy in Asia. We know that Chinese issuers able to tap the dollar offshore market tend to be the better established companies, and we derive comforts from that. These issuers tap the debt capital markets in big size. For example, Sinopec tapped last week for 3 billion. Bank of China debut subordinated debt was 5 billion. Alibaba debut print was 8 billion, and Tencent's debut print was 2.5 billion. The portfolio has an overweight China allocation versus the benchmark, and this is because China corporate papers offer good relative value compared to Korea, Singapore, Thailand credit names, which trade very tight on scarcity of new issuances.
What is the outlook for interest rate, and how does the fund position itself in terms of its duration?
With data points from the US coming in mixed, European economic growth momentum tepid, Japan's inflation target still not met, and uncertainty surrounding Brexit, there seems to be little ground to precipitate an aggressive increase in interest rates. We think central banks are likely to keep policy rates low for long. Markets are expecting US Federal Reserve to hike policy rates when they next meet in December 2016. What is more important than that one rate hike in December is the Fed's guidance for the path of future rate hikes in 2017. We expect Fed rhetoric to be measured. We expect the normalization of US interest rate to be a gradual process. As such, we expect to maintain slight underweight to neutral portfolio duration versus benchmark. The risk to this positioning is US labour market tightening and inflationary pressures starting to build up in the system, and the Fed having less room to maneuver and having to adopt a less dovish policy in 2017. There is further out risk, and the portfolio actively manages such risks through interest rate hedging.
Thank you for your insights today. For more information, please visit our website at poems.com.sg/unittrust or talk to us at 653 11555.